Hello and welcome to Money Control. You have tuned into IPO Watch and I'm your host Nickey Mirchandani. Today we are here to talk about Muthoot Microfin. It hits the primary market today, that is December 18th, and with the public issue of around 960 odd crore. Of the split, 760 crore is fresh issue and the another 200 crore is OFS. But the price band, of course, is in the range of 277 to 291 per share. It is the fifth largest NBFC MFI in terms of asset book. But to know more about the company profile, the strategy, financials, and mainly the cutting edge, we're being joined by Sadaf Sayeed, who's the CEO of Muthoot Microfin.
Good morning.
Morning there. Let's start off with the basics first. Tell us more about your business. Whom do you lend? And why come with the OFS? What's the purpose? Just the basic details out of the way, please.
Thank you, Nickey. Pleasure being here. I represent Muthoot Papachan Group, which is a large business conglomerate. We are primarily focused in NBFC vertical. This is second largest company within the group. Muthoot Microfin is 10,800 crores of asset under management. We focus on basically giving loans to household at the bottom of the pyramid. So our customers are typically women entrepreneurs. We form a group of ladies, 10 to 15, and we give them loans in a joint liability group format. The average ticket size of our loan is 51,000 rupees and it is given for a 24-month period of time. 30% of our portfolio is weekly repayment and 70% of our portfolio is a monthly repayment model. So they keep paying monthly. We are spread across 18 states and union territories with 1,340 branches covering 329 districts. As of September, we cater to around 3.2 million customers, active customers. The unique aspect of our business is we being a microfinance company, apart from taking the financial inclusion agenda forward, we are also taking digital inclusion forward. So we are a technology focused microfinance company. We have developed an app which is called the Mahila Mitra app. Out of the 3.2 million customers, we have done an extensive survey. We have understood from the customer that 84% of the household have a smartphone. Either the husband or the wife or the kid who's studying has a smartphone. So our effort is to reach to those household and take our app there. And app is a really empowerment tool. Typically in a microfinance business, your customer can interact with the company through a field officer. But in our operations, we have empowered the customer with this app. And with this app, she can request for additional loan. She can register any sort of a request. If she wants to check her loan track record, if she wants to check her repayment, she can do this. And this app also brings a lot of transparency. And one of the key aspects of our business, 100% of our disbursement is completely digital. We don't disburse any money in cash. All the money goes into the customer's bank account. And 33% of our collection incrementally is also digital. So it's coming through the wallet or the bank account of the customer. So that is what our focus is, and it is bringing a lot of efficiencies in our operation. Our cost to income ratio because of this has come down from 64% to now 46%. And we feel with the growth that we have shown in last 3 years, 36% CAGR growth, and the way the industry is growing, we can definitely bring in more efficiencies and offer better services to our customer. One of the unique aspects of our microfinance operation is that we can offer multiple products to our customers. So we are not only looking at microfinance as a service to the customer, we are looking at life cycle need of the customer. So as she grows in her life, she stays with us 4 or 5 years, and when she wants to take a kind of a home improvement loan, we are able to provide that to her. If she wants a two-wheeler loan, we can provide to her, and if she wants a business loan, we can provide to her.
Okay. So you actually covered in most of the questions that I could ask next. I was going to ask you, since you are the fifth largest NBFC MFI in terms of asset book, what is your cutting edge as compared to other NBFC's MFIs? And clearly you said the offering is multiple at that point of time. You look at microfinance, you talk about two-wheeler, you spoke about personal loan per se. Apart from that, what sets you apart from your peers?
So I think there are three more key differences that differentiate us from any other microfinance offering. Not only that we are the fifth largest, we are the third largest in South, and we are the largest in Kerala. But if you look at the key difference that we bring to the table is first, the brand name Muthoot is very well recognized, and when the product is getting offered from that same company, the customer kind of attach values to it, and it opens a lot of doors for us. We are able to kind of recognize and move forward. The second aspect is we are a technology driven microfinance company. As I said, we have a focus of digital collection. Apart from that, we have a superior asset quality. Our GNPAs are 2.37% and net NPA is 0.33%. And if I talk about portfolio that we have originated post-COVID, that is June 2021 onwards, our net GNPA is 0.67%, and this has been achieved by use of technology. So we have developed a credit scorecard with the help of Equifax, a well-renowned credit bureau, and we have studied 6.5 crore loan accounts in microfinance space, and after studying the customers, we have identified 40 parameters which influence the repayment behavior of our customers, and these 40 parameters have been given weightage. And based on that weightage, each customer gets a score, and that score, based on that score, the customer is divided into 4 categories: low risk customer, very low risk customer, medium risk customer, and high risk customer. Our focus is to ensure that we increase our wallet share into low risk and very low risk customers. In a lending business, basically you make 2 types of errors. One is you lend to a wrong customers. Which can happen in a lending business, but what in risk parlance we call a type 2 error, which is more fatal. That is, you have a good customer in front of you, but instead of offering him the customized product, you offer him a standard product. So the customer needs 80,000 rupees of loan, but you give a standard a 30,000 rupee loan or a 50,000 rupees loan. So you are missing out on that good customer's wallet share. So this scorecard helps us to maximize that wallet share.
I just wanted to understand 2 big things essentially, just sticking to the point in that case. 16% of your market share is in Tamil Nadu, and the company is the 3rd largest NBFC MFI, like you rightly suggested, in South India. Now, the basic point of concern rather is the fact that there is some amount of regional concentration here. Do you intend to diversify further? How is one supposed to look at the risk?
So currently, if you say 51% of our portfolio comes from South, South being Kerala, Tamil Nadu, Pondicherry, Karnataka, the 4 states and a union territory. So our 23% of the stake comes from North. Around 13% comes from East, which includes West Bengal, Odisha, Chhattisgarh, Jharkhand. We are not there in Northeast yet. And 12% come from West. And if you look at from our growth strategy is expanding our distribution network. So last year we had added 260 branches. This year in the first half we have added 160 branches. And with the help of these branches, last year we acquired 7,50,000 new customers. This year we have already acquired around 4 lakh new customers. So our strategy is to acquire new customers and ensure that we retain our existing customer with the help of our superior technology, with the help of our branch network, with the help of our superior services and offering. I think the growth that is coming from North and coming from West. So that is really kind of ensuring that we have a distribution network which is well spread across the country.
So the 16% market share in Tamil Nadu is expected to come down in the next 2 years?
So in terms of market share, we will continue to maintain our position. We are number 1 in Kerala. We are a dominant player in Tamil Nadu. We will continue to maintain that market position of ours. But as a composition of overall loan book, yes, definitely in our own mix, it will come down. We have a concentration risk policy where we ensure that not more than 25% of our AUM is in single state and not more than 5% is in single district. So that will continue to happen. But as we diversify more and more growth happens in North, that portfolio mix will definitely change.
So much of your growth now will come from North rather than South, if I'm supposed to look at it that way for the next 2-3 years?
Yeah, new customer acquisition definitely would be more from North and West. And our existing customer, we will continue to retain and offer them better services.
Okay. Your gross loan portfolio, actually that's jumped quite a bit, in excess of 45% in FY23 versus 25% in 2022. It's a sharp jump in terms of the growth number, right? At the time when most of the microfinance institutions are perhaps slowing down, being a little more cautious, you on the other side are a little more aggressive and perhaps scaling up at a 45% rate. How sustainable is this 45% rate? Which are the areas? One is for sure north, where incremental growth will come from.
Yeah, so we have grown at a 36% CAGR for last 3 years. During the period of COVID, we were a little bit more conscious. We had grown a little bit lesser, but we have utilized that period for putting together our technology. So this app that we have put together is during the COVID period, and the credit scorecard that we have put together is during that period, and that scorecard is really helping us to underwrite the customer better and understand the customer better, and which is really taking our growth to the next level. And we feel that as the industry is growing post COVID at a 25-30% growth rate, we can continue to grow with the industry. What we needed, if you would have seen the trend across the NBFC sector, people who were able to raise capital at the right time have continued to grow, and we raised capital through GPC in 2021, right at the peak of COVID. We raised around $60 million, and that has helped us grow. And this capital raise which we are doing through the IPO 760 crore, which help us further grow.
Okay, I'm just going to let you to pause for a bit. The gross loan portfolio you said is expected to now grow in line with the industry standards of 25%, if I'm not wrong. Have I got that correct?
So definitely we are demonstrating a better growth and fundamentals than the industry. We definitely think that we can outperform the industry peers. What I am indicating that the industry is growing at that pace, so growing at a 36% is not very out of ordinary.
Okay, so 36% is something that we are looking at still in this financial year, right? And you'll still continue to outperform the industry growth in that case.
That I can say that we'll continue to outperform the industry, that's for sure.
Okay. So, why the aggressive strategy, especially at the time when RBI is coming up with so much of regulation and the whole unsecured lending seems to have taken a little more cautious and slow approach? What explains this payoff?
No, I think 2 points here. One is on the strategy of reaching out to the customers. So, if you look at the entire microfinance space, it is estimated that around 17 crore households are there which are target segment for microfinance. Right now, the industry caters to around 7.5 crore households. So, that is that much more potential there to cater to those households. So, the growth will continue. The second aspect about RBI policy, I think actually it is quite positive for microfinance per se. The first thing that RBI has done, it has kind of separated between microfinance and consumption lending. So microfinance is not recognized as consumption lending. Second aspect is that increased risk weightage is applicable to only non-MFI companies. So in terms of microfinance company, they have kept away from the higher risk weightage, and even the lending that is done from banks under priority sector lending, that is also been kept away from higher risk weightage. So that would mean that more and more funds will come to microfinance companies to continue to increase the lending. The second aspect on the customer side, which is very positive, is that because of reduction in consumption-based lending, the over leveraging or overburden that the customer was feeling, that will reduce a little bit. So that way the repayment of the customer would be better. So I feel this overall the regulation is positive, and RBI is cognizant of the fact that microfinance loans are income generating loan, and at the bottom of the pyramid we are seeing a huge amount of improvement in activity.
I would also want to understand, with the fundraising, your capital adequacy ratio, which has dipped considerably in the last 3 years, at almost from 23% to 20% as of September 30. Now, this capital will suffice for how many years? You said you're going to be growing at a rate of 30-35%, which is going to be higher than the industry standard. The given capital will suffice for how many years at this run rate that we're looking at in loan book?
So if you look at our the capital raise, we are raising 760 crore primary capital, And the internal accruals also, if you look at the last 3 quarters consistently, we have clocked almost 100 crores of profit, and we are reporting a ROA of around 4.2% for the first half. And historically also pre-COVID, if you say, our ROA is around 4.5%. And if that continues, then I think with the internal accruals and the capital that we are raising for the next 2 years, this would be sufficient to support our growth. And also, we are also seeing expansion of NIMs. Our NIMs as of today are around 12.39%. And with the expectation that the policy rates may come down, definitely that will benefit us, and there would be expansion of NIMs. A part of see, it depends upon how much is the policy cut. If you look
what is the
at
kind of factoring in that you're doing in the run-up to elections, say by the end of this financial year?
So, if you look at the past, from around our cost has increased by around 84 bips, while RBI has increased the policy rate by 250 bips. We feel that definitely part of that policy rate would be rolled back, and that benefit will definitely come to us, and we will be able to pass part of that benefit to our customer, and part of it will hit the bottom line. Definitely, it will support.
That's exactly what I'm asking. How much part of it do you think? What's your roundabout estimate that you're working with?
Yeah, anticipating policy rate cuts of around 25 to 50 bips, if they come in, then definitely that will aid to both the sides.
So then what is the kind of NIMs one can look at if 25 to 50 basis point is the number that we're looking at? By end of FY24, what is the number that one can look at?
So we are currently operating at 12.39% of NIM. Definitely, if there is a 50 basis cut, that will come to our benefit, but part of it we will definitely want to give to our customers. So depending upon the board approved policy, we will ensure that this reduction in cost is definitely shared with the customer, and it supports our bottom line also.
So a range that we can look at, 13-14% is doable?
See, if you look at the industry, they are like at around 12.5%. So that is what I feel that that would be the range.
You expect to sustain your NIMs level here on for FY24 even after the rate cut comes through?
Correct.
Okay. And you said your capital adequacy ratio will be, the capital that you raise now will be for sufficient for how many years? 2 years?
Next 2 years.
Okay. Yeah. All right. Also, the company plans to evaluate strategic acquisitions on opportunistic basis, right? Which are the pockets that you've identified for your inorganic growth, if at all? Organic, sure, you spoke about North and various products, but inorganically, anything that you've streamlined or perhaps in talks or in discussion in pipeline, how are you looking at it?
So right now we have no plans to have an inorganic growth, so no plans of acquisition of any thing right now. Right now our focus is to grow organically, expand our distribution network, acquire more customers. The strategy is to acquisition of new customer and increasing our wallet share with the customer, existing customer, retaining that customer. We have a 84% customer retention ratio, continue to deliver that and improve on that, and offer superior services to our clients. That's the strategy. Traditionally also we have not looked at acquisition of any company. We have grown organically from the day one, and we feel that's the best strategy.
Let's talk about one more thing which is working in the favor of the company, which is asset quality, right? GNPA has improved from 7.4% in 2021 to a number of 2.97% in FY23. What's your comfort level when it comes to the GNPA? What kind of further improvement can we see in this financial year?
Yeah, so I think GNPA in the first 6 months have further improved from 2.97% in March. By September, it is 2.37%. And net NPA is 0.33%. So if you look at our credit cost has been much better as compared to the industry, and if you look at the portfolio that we have originated post-COVID, which represents almost 97% of our book today, in that portfolio we have only GNPA of 0.67%. So largely the total GNPA portion is prevailing to the earlier book. 1.7% is from the pre-COVID book. And as we recover more money from that and whatever we write off, then the NPA number will further reduce. I think real representation of our asset quality is the portfolio that we have originated post June 2021, which is 0.67% of GNPA. And 97% of the book is that. So that's what
you said 1.47% pre-COVID is what has been carried forward in your asset quality, which contributes towards your GNPA. What kind of recoveries are you expecting from that 1.47% in this financial year to come up to a certain set of number? If you can give us a broad range of what kind of GNPAs one can look at, also it will provide more perspective.
Yeah, so we have a strong recovery practice. So we have a well-established escalation metrics for a recovery. We have a team of 313 people who are focusing on recovery. So 0 to 30 bucket is focused by the branch team itself. Anything which goes more than 30 up to 90 is handled by a centralized telecalling unit. Anything which goes more than 90, that the centralized risk containment unit follows up with the customer and recovers. Anything which goes more than 180, we have a legal team which does arbitration, reconciliation or lok adalat to recover money. Traditionally, we have seen that out of our NPAs, we are able to recover between 37 to 40% money we are able to recover. We feel that this trend will continue. And part of it, like we can see the improvement in the asset that we have seen. 97% of our assets are stage 1 assets, and post COVID whatever we have originated, the NPA is 0.67%. I think that will hold good in the long run as well.
All right, gentlemen, I think we'll just leave it at that, and thank you for taking out the time and having this conversation with us. But just summing it up in exactly 4 points, it's actually a 5th largest NBFC that we are talking about, which is differentiated in terms of the various products offering. Second, it expects the loan growth to be in the range of 35% in this financial year. It is diversifying in north for incremental growth, and NIMs are expected to remain around that 12% level in this financial year. But with this, it's a wrap. Thank you so much for tuning in.